Hi, Dave Feldberg. I'm here today with Beny Rabuchin with New American Funding. And today we want to talk about what are the credit factors that can affect a borrower's interest rates, better, worse, that kind of thing.
It's funny, I get called a lot saying, Benny, what is the interest rate today on a 30-year fix? And that's really kind of a loaded question. The reason for that is there are a few factors that go into what interest rate that we can offer. Some of those things are credit score. Credit score typically for most loan programs carries the most weight on what rate you're going to be offered.
Sure.
The other is what is your loan amount, or more importantly, what is the equity position? So what is your down payment? Are you doing 3.5% down? Are you doing 50% down? Typically, in most cases, the more down payment you have, the better interest rate you're going to get. The same would go for a credit score. Your higher credit score, the better interest rate. Another factor that plays into this is the property type. So if you're buying a condo opposed to a single family home, typically a single family home will yield a better interest rate. Most lenders see condo as a little more risk, so there's usually a little add-on to your interest rate for that. The same would go if you're buying a duplex or a triplex or a fourplex. Typically they'll yield a little higher interest rate for those types of properties. So when asking what the interest rate is, these are the things that the lender needs to know to quote you accurately on interest rate.
Ultimately, it sounds like it's just a question of risk.
That's it.
More risk, higher the rate. Less risk, less
Absolutely,
rate.
That's how it works, yeah.
Okay. Good information, thank you. Dave Feldberg, Coastal Real Estate Group. If you have any questions about this, feel free to reach out to us. We can connect you with Beny right away. Thanks.